Hey everyone, welcome back to Corporate Decoder, where we decode the hidden stories inside company reports and make it super simple for you to understand. Today we're diving into XChange TEC.INC's latest financial report. And let me tell you, it's a roller coaster with some pretty wild swings, especially when it comes to their business operations and their finances. First off, the company's revenue has seen a massive jump. From the 6 months ending in March 2024 to March 2025, revenue shot up by a huge 129%. That's from about 76.7 million renminbi. What does this mean? Well, it mostly comes from the acquisition of AlphaMind back in December 2023. In the earlier period, they only had 3 months of AlphaMind's results, but now they've got a full 6 months. So it's not necessarily that their core business is booming by that much, but rather that a new, larger part of the business is now fully included in their reported numbers. Following that revenue increase, the cost of generating that revenue also went up big time by 136%. This makes sense because costs of revenue are usually commissions paid out. So more revenue means more commissions paid out. Now, here's where things get really interesting and a bit concerning. The company recorded a goodwill impairment loss. What's goodwill? Think of it as the extra value a company pays for another company that isn't tied to any specific physical assets or patents. It's often for things like brand reputation or market position. In this case, they took a hit of 60.449 million renminbi, or about 93.4 million US dollars. This is a huge number and mainly reflects that the acquired company AlphaMind didn't perform as well as expected. This is a non-cash charge, meaning it doesn't affect their immediate cash flow, but it does show a significant drop in the perceived value of that acquisition. Because of this goodwill impairment and other costs, their loss from continuing operations dramatically increased. It went from a loss of 5.6 million renminbi in the first half of 2024 to a staggering 658.6 million renminbi in the first half of 2025. That's a massive increase in their losses from their main ongoing business activities. The company's interest expense also grew by a considerable 66.3%. This is largely due to the promissory notes they issued to pay for that AlphaMind acquisition. These notes carry a 3% interest rate and it's eating into their profits. Let's look at the big picture balance sheet. The company's total shareholders' deficit has ballooned. It went from a deficit of 556.6 million renminbi in September 2024 to a massive deficit of 1.2 billion renminbi by March 2025. A deficit means the company owes more than it owns. This is a really significant deterioration. The cash situation also shows a decline. The cash equivalents and restricted cash dropped from 13.1 million renminbi to 9.9 million renminbi. While it may not seem like a huge amount, given their massive losses and deficits, every bit of cash counts. This brings us to the accumulated deficit, which is basically the total losses the company has made over time. As of September 2024, it was about 3.9 billion renminbi, and by March 2025, it had grown to over 4.5 billion renminbi. This indicates a long history of not being profitable. And this leads directly to a serious warning sign, the going concern note. This is a standard disclosure when a company's financial situation raises doubts about whether it can continue operating for the next year. The report explicitly states that their accumulated losses, the consistent use of cash in operations, and the fact that their liabilities are much higher than their assets raise substantial doubt about their ability to continue as a going concern. This is the most critical red flag in any financial report. Even with these serious financial challenges, the company is planning to raise funds by issuing more shares. They're hoping to use their existing effective shelf registration statement to get money for operations. They also have a commitment from one shareholder for up to $1 million, plus they have an agreement with VG Master Fund where they can sell up to $25 million worth of shares. Management believes these plans could be enough for reduced operations, but there's no guarantee. They warn that if they can't get this money, they'll have to cut spending, which would hurt their business even more. Let's revisit the revenue figures. While the total revenue looks good on paper, the cost of those revenues, which are essentially commissions paid out, increased at a faster rate than revenue itself. For every 100 renminbi of revenue, they spent nearly 97.5 renminbi on commissions in the first half of 2025, compared to about 94.5 renminbi in the first half of 2024. This means their gross profit margin, the money left after paying commissions, is shrinking. Their selling and marketing expenses more than doubled, from 2.9 million to 6.1 million renminbi. The company says this is due to a strategy shift and business promotion. However, with increasing losses and a questionable going concern status, pouring more money into marketing might be a big gamble. The net loss per share for the 6 months ended March 2025 is a tiny fraction of a cent, negative 0.00. While this sounds like nothing, it's a result of a massive increase in the number of shares outstanding because of share consolidations and new issuances. They went from about 28 million shares to over 2.4 billion shares. So even though they are losing a lot of money, the losses spread across so many more shares that it looks like a very small number per share. Something to note is the impact of foreign exchange rate changes. They had a loss of 877,000 renminbi in the first half of 2025, which also contributed to their overall losses. Going back to the AlphaMind acquisition, the report details that the purchase price of $180 million was paid with promissory notes. They've extended the maturity date for these notes until December 31, 2025. This means they still have a significant debt obligation looming. Crucially, the goodwill from this acquisition was 1.28 billion renminbi, and they've already taken a 642.8 billion renminbi, and they've already taken a 644.9 million renminbi impairment. This implies the value of AlphaMind has dropped significantly since it was acquired. Looking at the financials broadly, XChange TEC.INC is clearly in a very precarious position. Their revenue is growing due to acquisitions, but their core operations are losing a lot of money. And they've been hit hard by a massive goodwill impairment. The growing shareholder deficit and negative cash flow are major red flags, indicating they are struggling to stay afloat. While they are trying to raise more funds, the fact that they have a going concern warning means investors need to be extremely cautious. The company is heavily reliant on future financing to survive, and there's no guarantee that financing will come through or on favorable terms. The strategy shift in marketing spending while facing massive losses also seems like a high-risk move. In conclusion, XChange TEC is currently facing significant financial challenges. The acquisition of AlphaMind has brought in more revenue but also massive write-downs and increased debt obligations. The company's future is uncertain, hinging entirely on its ability to secure substantial new funding. Alright, that's our deep dive into XChange TEC's latest report. What do you think about their financial health and their aggressive growth strategy despite the losses? Let us know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe to Corporate Decoder for more insightful analyses. And don't forget to join our Discord community, the link is in the description, to continue the conversation and connect with other finance enthusiasts. Thanks for watching and we'll see you in the next one.